Welcome in everybody to our deep dive into Warren Buffett's 2004 letter to Berkshire Hathaway shareholders.
All right.
This letter, it's really is a goldmine of insights,
Yeah.
and you'll see how it captures his thinking during a very peculiar time right after the dot-com bubble burst.
Oh, it really is. It's like a time capsule,
Yeah.
revealing his views on investing the economy and how he runs his businesses.
Yeah, exactly. And remember, this is Warren Buffett. We're talking about the Oracle of Omaha. He doesn't just pick stocks; he buys businesses.
Absolutely.
So let's jump into his 2004 letter and see what kind of gems we can unearth.
Sounds good.
So first off, how did Berkshire Hathaway actually perform that year?
Well, their book value per share grew by 10.5%, which actually lagged behind the S&P 500's 10.9% return.
So not exactly a banner year.
Not in terms of beating the market, no.
Mhm.
But Buffett really emphasizes that he's not playing that short-term game.
Right.
He's focused on building intrinsic value, the true worth of a business, which might not always be reflected in the stock price on any given day.
Mm-hmm.
In fact, he points out that Berkshire intentionally decreased its equity holdings as a percentage of net worth, making them less sensitive to those yearly stock market swings.
Yeah, that makes sense. It's like
Yeah.
he's built this fortress that can withstand the market storms.
Precisely.
Now, you can't talk about Berkshire Hathaway without diving into their insurance business. It's been the core engine of their growth for decades, and 2004 was no different because of that float.
Exactly.
Yeah.
Float is simply the money Berkshire holds from insurance premiums,
Right.
money that they can invest.
While they're waiting to settle claims.
Yeah.
And they've actually managed to make this float better than free many times, meaning they achieve an underwriting profit making money from holding other people's money. It's a pretty incredible feat.
It is, and one of the key drivers of their success in insurance is a company called National Indemnity, or NIO. Now, here's where it gets really interesting. For years, they actually shrunk the business intentionally.
Wait, they intentionally shrunk the business?
They did.
Wouldn't that make employees nervous?
You'd think so,
Yeah.
but Buffett explains that NIO had this culture of discipline
Mm.
and even promised employees no layoffs due to declining volume. They would rather lose business than write policies that weren't profitable.
Okay.
They stuck to their guns and maintained underwriting profitability even as their premiums drastically declined from 1986 to 1999.
So they basically said we'd rather be smaller, more profitable, and keep our promises to employees than chase growth at all costs.
Exactly. It's all about playing the long game. Now, contrast this with Geico, another Berkshire insurance giant.
Right. Geico is all about offering those super low prices and growing their customer base rapidly.
Exactly. Geico's strength lies in being the low-cost operator.
Hmm.
Two very different approaches, both incredibly successful under the Berkshire umbrella.
It's amazing how they manage such diverse businesses. And then there's reinsurance too, right?
Yes, reinsurance is essentially insurance for insurance companies.
Okay.
Berkshire takes on risks that other insurers don't want to touch, especially, those mega catastrophes that could bankrupt smaller companies.
Okay.
It's been a very profitable strategy for them.
So they're not afraid to be the ones standing in the storm.
Not at all.
Yeah.
They have the financial strength and the expertise to handle it. Now, let's shift gears and look at Berkshire's stock portfolio, specifically what Buffett calls his Big Four holdings at the time.
So you're talking about American Express, Coca-Cola, Gillette, and Wells Fargo, right? I mean, those are some iconic brands.
They are, and Buffett reminds us to think about stocks as fractional ownership in businesses, not just ticker symbols. He lays out the numbers for you in the letter, showing how he invested $3.83 billion in these four companies between 1988 and 2003, and in 2004 alone, they generated $1.2 billion in earnings for Berkshire.
Wow. Talk about a solid return. But didn't he also admit to missing out on the dot-com boom?
He did. Buffett openly acknowledges that he didn't capitalize on that period of crazy valuations. He just couldn't justify buying into companies with sky-high prices that didn't match their actual earnings or business prospects.
So even the Oracle of Omaha isn't perfect.
Even he misses some opportunities, but there's a valuable lesson there too. Sticking to your investment principles and not getting swept up in market hype is crucial, even when everyone else seems to be making a fortune. Now, here's another intriguing part of the letter. Berkshire was sitting on a mountain of cash in 2040, $43 billion, and they weren't happy about it.
Because cash wasn't exactly earning much at the time.
Right. Low interest rates meant their cash wasn't generating the kind of returns they were used to.
Right.
So what did Buffett do? He made an unexpected move into foreign currencies, something he'd never done before.
That seems like a pretty big departure for someone who's known for sticking to what he understands what prompted that.
It was all tied to his concerns about the U.S. trade deficit and the weakening dollar. He was worried about the U.S. consuming far more than it was producing, leading to a massive trade deficit and a growing reliance on foreign debt. He called this unsustainable pattern pseudo-trade, essentially borrowing from the world to fund our consumption habits.
Yeah, it's fascinating how he connected those big economic trends to Berkshire's investment strategy.
He saw the potential for the dollar to weaken, and he wanted to protect Berkshire's capital. He even painted a picture of the U.S. potentially becoming a sharecropper society, sending a large portion of its output abroad just to service foreign-owned debt.
That's a pretty powerful image. So he was looking for ways to diversify and hedge against potential risks to the U.S. economy. It makes you wonder what he would think about today's economic landscape. But let's get back to the letter. He also talks about some governance reforms he implemented at Berkshire, right?
He does. Buffett implemented two key reforms requiring regular board meetings without the CEO present to encourage independent thinking among directors and establishing a whistleblower line for employees to report concerns without fear of reprisal.
This seemed like pretty straightforward common sense practices.
You would think so, but you'd be surprised how many companies don't prioritize these things. And Buffett even admits in the letter that a whistleblower line would have been valuable decades earlier. It highlights the importance of creating a culture of transparency and accountability.
Absolutely. Speaking of accountability, Buffett also had some strong words about stock options and how companies were accounting for them at the time.
This is a topic he's very passionate about. He argues that not expensing stock options, essentially treating them as a freebie, distorts earnings and benefits CEOs at the expense of shareholders.
He saw it as a way for companies to hide the true cost of compensation.
Exactly, and he didn't hold back in criticizing Congress for perpetuating this accounting loophole, even including an op-ed he wrote for the Washington Post, denouncing a bill that aimed to further weaken option expensing rules.
Wow, he really put himself out there on this issue. It's clear that he believes in fair and transparent accounting practices, but what did he think about stock options as a form of compensation in general? Was he totally against them?
He wasn't against stock options per se, he just wanted them to be accounted for properly reflecting the true cost of the company. He believed that if options were expensed, companies would still use them, but more responsibly and in a way that actually created value for shareholders.
So it was all about aligning incentives and making sure everyone was playing by the same rules. Well, we've covered a lot of ground already, from Berkshire's performance to the intricacies of their insurance business, their Big Four stock holdings, and even some macroeconomic concerns about the trade deficit and the dollar. It's incredible how much insight he packed into a single letter.
We've only just scratched the surface. There's so much more to unpack, from his brilliant bond investments to his thoughts on corporate governance and the importance of shareholder activism.
This is definitely a deep dive worth taking. We'll be back with part 2 of our exploration into Warren Buffett's 2004 shareholder letter. Stay tuned. Welcome back. We're continuing our deep dive into Warren Buffett's 2004 letter to Berkshire Hathaway shareholders. In part 1, we explored his views on everything from insurance to the U.S. trade deficit.
It's remarkable how he connects those seemingly disparate topics, isn't it? You can really see the wheels turning in his head as he analyzes the world and positions Berkshire accordingly.
Absolutely. He's always thinking a few steps ahead, anticipating those potential risks and opportunities. Now, before the break, we were talking about his strong stance on expensing stock options. He saw it as a way for some CEOs to enrich themselves at the expense of shareholders.
Right, and he wasn't just complaining about it. He actively tried to change the system. He even included this really powerful op-ed piece he wrote for the Washington Post, denouncing a House bill that tried to weaken option expensing rules.
He was really fired up about this issue, wasn't he?
Oh, he argued that not expensing options was this blatant distortion of earnings benefiting CEOs while misleading investors about the true cost of compensation.
He believed that accounting rules should reflect economic reality, not serve the interests of those who benefit from obfuscation. He really hammered that point home.
He even criticized Congress for being complicit in perpetuating this accounting loophole, despite strong opposition from auditors, accounting standard setters, and investors.
So he was taking on some pretty powerful interests with this crusade. It makes you wonder if his efforts had any impact on the eventual accounting rule changes that required companies to expense stock options.
It's hard to say for sure. but his voice definitely carried a lot of weight. He was and still is a respected figure in the business world, and when he spoke out about something, people listened. Now, let's shift gears and look at one of his more successful investments that year, a bond play that highlights his incredible knack for finding value where others don't.
This is the level 3 bonds story, right? I remember reading about that. It's a perfect example of how Buffett can capitalize on both a company's improving credit and a favorable currency move.
Exactly. In 2001, he bought 254 million euros of level 3 bonds at a significant discount to their face value back then. The market was skeptical of level 3's prospects, but Buffett saw an opportunity. Fast forward to December 2004, and he sells those bonds for a substantial profit.
So how did he make out on that deal? Break down the numbers for us.
He lays it out pretty clearly in the letter. About 85 million euros of the gain came from the market's improved perception of level. Credit quality investors started to believe in the company's turnaround story, and the bond prices rose accordingly. Here's the kicker. The remaining 78 million euros came from the appreciation of the euro against the dollar.
So he essentially got a 2-for-1 deal-making money from the bond itself and from the currency play.
Precisely. It's a testament to Buffett's multifaceted investment approach. He's always looking for opportunities, whether it's in undervalued businesses, distressed debt, or even currencies. He's not afraid to explore different asset classes if he sees value there.
It's almost like he has the sixth sense for where the market's going to go. Speaking of market trends, let's revisit his concerns about the U.S. trade deficit and its implications for the dollar. We touched on this in part 1, but it's such an important topic that it's worth exploring further.
Absolutely. This was a recurring theme in his letters. Throughout the early 2000s, he argued that the U.S. was consuming far more than it was producing, leading to a massive trade deficit and a growing reliance on foreign debt.
And as we discussed, he called this unsustainable pattern pseudo-trade, right? Essentially living beyond our means and borrowing from the world to fund our consumption habits.
Exactly. He was worried about the long-term consequences of this imbalance. He argued that it could lead to a sharecropper society, where the U.S. is essentially sending a significant portion of its output abroad just to service its debt.
It's a pretty sobering assessment of the economic landscape. It makes you wonder what he would think about the even larger trade deficits we've seen in recent years.
That's a great question. I'm sure he would still have some pretty serious concerns about the sustainability of such imbalances. But let's move on from the macro picture and zoom in on some of Berkshire's operating businesses. The 2004 letter provides some interesting insights into how those companies were performing.
I'm especially interested in the story about R.C. Willey, the home furnishings retailer. They expanded into Las Vegas that year, and Buffett had some initial doubts.
He tells this amusing story about how he initially thought their closed on Sunday policy would be a deal breaker for their expansion into Las Vegas.
Yeah.
He just couldn't imagine a retail business thriving in a city that never sleeps without being open 7 days a week.
But he was proven wrong.
Oh, absolutely.
Yeah.
The Las Vegas stores became their top performers, exceeding even Buffett's expectations. He jokes about how he's always wrong and how that has its own utility to the decision makers at R.C. Willey. It gives them even more confidence to go with their gut instincts, even when the Oracle himself has doubts.
That's a great lesson in humility, even for the greatest investors. Sometimes the people closest to the business have the best insights, and it sounds like Buffett is secure enough to admit when he's wrong and learn from those experiences.
Exactly. He's not afraid to trust the judgment of those who are running the businesses day to day. Another interesting anecdote from the letter involves Flight Safety, the pilot training company, and its founder, Al Welchie.
Oh, yes. This is the one where Yulchi refused to pass a tycoon friend of Charlie Munger's during training. Sounds like a pretty gutsy move.
He had this strict adherence to safety standards, even when dealing with influential individuals.
That's impressive. He didn't let personal connections or pressure compromise his commitment to safety. It speaks volumes about the culture of excellence that Yulchi instilled at Flight Safety.
And that culture of excellence is something that Buffett clearly admires and values in the businesses he acquires. He's always looking for companies with strong management teams, a commitment to quality, and a durable competitive advantage.
Now, we can't talk about Berkshire's businesses without mentioning NetJets, the fractional aircraft ownership company. This was a business that Buffett was personally passionate about even before Berkshire acquired it.
Absolutely. He viewed selecting a flight provider as akin to picking a brain surgeon. You simply want the best.
He highlights Rich Santulli, the founder of NetJets, and his fanaticism about safety and service.
And he talks about NetJet's growth both domestically and internationally. Yes, he does. He acknowledges that Europe has been a challenging market, more expensive than he anticipated, but he emphasizes its importance for building a truly global flight operation.
He sees it as a long-term investment essential for serving NetJet's growing customer base around the world.
And that long-term perspective is a recurring theme throughout the letter.
It's a great reminder that investing is not about chasing quick profits, but about owning pieces of businesses and participating in their growth over time.
He highlights companies like Clayton Homes, the manufactured housing company, and how Berkshire's financial support has been crucial for their success in a challenging industry.
He also talks about the importance of having the right CEO, someone who shares his values and can be trusted to run the business as if it were their own.
Kevin Clayton, the CEO of Clayton Homes, is praised as a prototype Berkshire manager, someone who thinks like an owner, and is focused on building a strong and enduring business. Now, before we wrap up part 2, we need to talk about a topic that's near and dear to Buffett's heart, the role of shareholders in corporate governance.
He's always been a strong advocate for shareholder rights, hasn't he? He believes they should have a real voice in how companies are run.
Absolutely. He criticizes the checklist approach to corporate governance that was prevalent at the time, where institutions focused on minutia while ignoring the big picture.
So he felt they were getting bogged down in details and missing the forest for the trees.
Exactly. He believes shareholders should be asking tough questions about CEO performance compensation and acquisitions, and they should be willing to speak up when their interests are not being served.
He wants them to be active owners, not passive bystanders.
Precisely. He even shares a personal anecdote about being targeted by institutional shareholders who questioned his independence as a director of Coca-Cola.
This is where his famous quote about treasure comes in, right?
Yes. They argued that his business dealings with Coke through other Berkshire subsidiaries compromised his ability to act in the best interests of Coke's shareholders.
But he vehemently refuted that claim, didn't he?
He did. He pointed to Berkshire's massive stake in Coke stock, $8 billion at the time, as proof of his alignment with shareholders. He argued that his treasure, that huge stake, dictates where his heart lies.
It's a pretty powerful argument, and he uses it to illustrate the flaws in the conventional definition of independence on corporate boards.
He believes that true independence comes from aligning financial interests with those of shareholders, not from arbitrary rules and checklists.
It's a thought-provoking perspective on corporate governance. He's essentially saying that skin in the game is the best indicator of whether someone will act in the best interests of the company and its owners.
Well, we've covered a lot of ground in this episode, from stock options and bond plays to the U.S. trade deficit and corporate governance. It's amazing how much ground this letter covers.
It's a testament to Buffett's wide-ranging intellect and his ability to connect seemingly disparate ideas.
And we're not done yet. We still have more to uncover, including his insights into accounting the importance of cash flow and his reflections on his own investment journey. We'll dive into all of that and more in part 3 of our deep dive into Warren Buffett's 2004 shareholder letter. Stay tuned.
Welcome back to our deep dive into Warren Buffett's 2004 shareholder letter.
Okay.
You know, we've been exploring his investment philosophy, his take on the economy, his management style.
Right.
Even some, juicy anecdotes about the businesses under the Berkshire Hathaway umbrella.
Yeah, it's incredible how much we can learn from a single letter.
I know. It's like having a direct line to one of the greatest investing minds of all time.
Absolutely.
And in this final part, I want to dig into a topic that might seem a little dry at first.
Okay.
But trust me, it's crucial to understanding Buffett's approach accounting.
You might be surprised how much he talks about accounting in this letter.
Yeah.
He's a big believer in transparency and accuracy when it comes to financial reporting. He even dives into specific practices that he finds problematic, like the non-expensing of stock options, which we discussed earlier.
Right. He saw that as a way for companies to manipulate earnings and hide the true cost of compensation, ultimately misleading investors.
Exactly. He believed that accounting rules should reflect economic reality, not serve the interests of those who benefit from obfuscation.
Yeah.
He wanted to level the playing field and make sure everyone was playing by the same rules.
Now, another accounting topic he tackles is the way insurance companies book profits and losses. This is where the concept of float comes back into play, right?
Precisely. Remember, float is the money that insurance companies receive up front from premiums, but don't have to pay out in claims until later.
Right.
This creates a time lag between when revenue is recognized and when expenses are incurred.
So what's the problem with that? Seems like a pretty sweet deal for insurance companies.
It can be, but there's also potential for abuse.
Oh.
Buffett warns against aggressive reserving practices where insurance companies essentially understate their liabilities to make their profits look better in the short term.
So they're basically kicking the can down the road, hoping that those claims won't come due, or at least not as high as they've estimated.
Exactly. And Buffett emphasizes that this can lead to serious problems down the road. He even points to Geico's near collapse in the 1970s as a cautionary tale.
Wow.
They had under-reserved for claims, and when a wave of accidents hit, they almost went bankrupt.
Yeah, it's a reminder that you can't fudge the numbers forever. Eventually, reality catches up with you.
Buffett is a firm believer that insurance companies, and really all businesses, should be conservative in their accounting practices. They should err on the side of caution, reflecting the true cost of potential claims and expenses.
It's all about building a sustainable business for the long haul, not just chasing short-term profits now beyond specific accounting practices. Buffett emphasizes the importance of understanding the underlying economics of a business. He argues that investors should focus on cash flow, not just reported earnings.
Yeah, he's all about looking beyond the headlines and digging into the real drivers of value creation.
Because cash flow is king, right? It's the lifeblood of any business.
Exactly. It's what allows companies to invest in growth, pay dividends, and weather economic storms. Buffett even provides some simple metrics for evaluating businesses like return on equity and return on invested capital.
These metrics help investors assess how efficiently a company is using its resources to generate profits.
Right. He's not just looking for companies with high earnings. He's looking for companies that can consistently generate high returns on the capital they employ. And he stresses the importance of understanding a company's competitive advantages, those special qualities that allow it to outperform its rivals.
He often talks about the moat around a business, right? Like a castle defending itself from invaders.
Exactly. He's looking for businesses with durable competitive advantages, those that can withstand competition and continue to generate profits for years to come.
Now, throughout this letter, Buffett doesn't just talk about numbers and strategies. He also shares personal anecdotes and reflections that give you a glimpse into his own journey as an investor.
He talks about his early days learning from mentors like Ben Graham, the father of value investing. He shares stories about his experiences on corporate boards, highlighting the importance of good governance and ethical leadership. And he even reflects on his own mistakes, acknowledging that he's not infallible.
It makes him seem more human, doesn't it? He's not just this distant, all-knowing oracle. He's someone who's made mistakes, learned from them, and continued to grow over time.
Absolutely. And that's a powerful message for all of us, whether we're seasoned investors or just starting out. It's a reminder that learning is a lifelong journey, and we should never be afraid to admit when we're wrong.
Well, as we wrap up this deep dive into Warren Buffett's 2004 shareholder letter, I'm struck by how much wisdom is packed into these pages. It's not just a financial document.
Right.
It's a masterclass in investing, business, and even life.
Yeah, he seamlessly weaves together business insights, investment philosophy, economic analysis, and even personal reflections, creating a tapestry of knowledge that's both insightful and engaging.
His ability to communicate complex ideas in a clear and concise way is truly remarkable. He doesn't talk down to his audience, but he also doesn't shy away from tackling challenging topics.
And he does it all with a touch of humor and humility that makes you want to keep reading, even if you're not a finance expert.
It's a reminder that the principles of sound investing and ethical business practices are enduring even as the world changes around us. And it's a testament to the power of clear thinking, long-term vision, and unwavering integrity.
If you haven't read Warren Buffett's 2004 shareholder letter, I highly encourage you to do so. It's a timeless classic that offers valuable lessons for investors and business leaders alike.
Thanks for joining us on this deep dive. We hope you found it as enlightening and engaging as we have. Until next time, keep learning, keep exploring, and keep investing in yourself.